So the revaluation of the gold price will come. We estimate a price of 4,800 in a very conservative scenario. If we see a more inflationary scenario, we would estimate something close to $10,000.
Please join us for our next live stream Sunday, June 28th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, June 28th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, housekeeping aside, if you are new to this channel or you have not already done so, please do subscribe, click on the bell to be notified of new updates, and give us a thumbs up if you like what we do. We really do appreciate your support. We're happy to have a return guest today, Mark Valek, partner of Incrementum AG, an independent investment and asset management company based in Liechtenstein. He co-authors the well-known In Gold We Trust report with Ronald Storfler, a benchmark report on gold, money, and inflation. And for you out there who follow our live streams, you know we have been referencing their publication. It's that good. It's time to saddle up and silver up for Mark Valek. Mark, welcome back to SBTV. How are you doing?
I'm fine, Patrick. Thanks for having me.
Thanks for coming back. We're glad you could have some time for us again. It's always a treat to have you on, especially with your report, the In Gold We Trust report. I think you guys did an incredible job once again for this 2020 edition. Thank you for it.
Thank you.
Thank you also, Mark. A lot of change since the last time we spoke, and I've heard this word, unprecedented. I've heard this word so much in 2020, I think more than I've ever heard in my lifetime. And in your report, we counted 13 times you used the word unprecedented. How would you describe 2020 so far? Were you surprised by how rapid the changes to the world was?
Well, obviously, yes. I mean, the big game changer was the COVID story. We will probably talk about that. But I think we were on a pretty unstable track already going into this year. So in 2019, and that's something we talk about already in the intro of the report, things weren't looking that good economic-wise, especially in the US. The economy was starting to cool off. Fed came back expanding the balance sheet already in 2019. So it looked to us that we were probably going to head into a slowdown or into a recession anyway. And then this whole thing popped up with the COVID story. And that's been a huge game changer on top of it. So yeah, we are living in unprecedented times. But then again, we are always living in unprecedented times. So things always are changing. But I agree with you. It definitely feels as if the world is spinning faster and faster every day.
Yeah. You know, now that your team publishes the In Gold We Trust report, and it typically comes out in May of every year, and the onset of this COVID-19 crisis would have hit very near to the report going out to print. Can you share with us how the pandemic crisis impacted the content of this year's report, and was there a scramble to rewrite major sections of the report?
Well, that's a good point. So as you know, we write a very extensive report every year. And we obviously have to have a cut-off date where we will just stop writing and we need to do the editing and the translating. So the final phase is really quite strenuous and also in terms of coordination, quite a challenge. And we actually every year have this coming up. So I remember 2016 was a very extreme case in our case because I think just 1 week before we published, Brexit happened. And so, I mean, that's really bad if you publish a report and something very fundamental happens. I mean, Brexit didn't happen, but the election happened and was, for the most people, surprising that they voted to go out of the EU. And that was something major we had to address. So that back then it was really bad. We really urgently had to address this point still. This year, the big news came out already earlier, so we had sufficient time to process the information, think about how will the consequences be, and also address it in our report extensively. So this year wasn't so bad as in other issues, but yeah, a major point, obviously, the COVID crisis.
Yeah, I can't imagine how it must have been in that office. But can you share with us why the dawning of the golden decade was selected as the title of this year's report, and what does it represent?
Well, that's also always a big question. We do want to title the report with a very pointed title, obviously. And since we've been entering a new decade, or are entering a new decade right now, we generally thought we want to give a even bigger picture, or a little bit a picture of the longer horizon picture, because everybody's stuck so much in their daily business or in the daily news, especially if you're a financial analyst and so on. So much going on. And we wanted to zoom out a little bit and give also the bigger picture in terms of the time horizon. So looking at a decade, obviously, and trying to anticipate what will be going on in a decade is obviously extremely difficult. But we are very convinced that this decade will be a golden decade. So especially for gold investors. And why? A lot of reasons, we can talk about it. But yeah, the COVID story is a game changer. But then again, also, we don't want to focus only on that. I think it's really important to get the broad picture in terms of financial stability, in terms of debt sustainability, and these things are looking pretty shaky. And yeah, we are going to see, I think, a lot of unprecedented things going forward, and these measures, in our view, lead to a very positive development for gold for the coming years.
Yeah, that word unprecedented. With the impeachment, we almost had an unprecedenting earlier this year.
Right.
But, which event that has happened in 2020 so far would you consider as the most important thing we should take note of, which would have major repercussions for the rest of the year? Things like maybe the Fed and their money bazooka, or things like that.
Well, one of our major conclusions was, and we've been pointing this out during the past editions of our reports. I think by now it's clear that there will not be any monetary normalization, and a normalization of the monetary policy. We heard this for many years. The balance sheet was expanded, as we all know, a lot during the financial crisis, and also in the aftermath of the financial crisis. We had then different other events like the Euro crisis, where ECB started expanding their balance sheet. But in all these events, during all these times, this was basically argumented that this would be a one-time event, and that these measures, these balance sheet expansions, these zero interest rates, negative interest rates, will be taken away as soon as things normalize. And I think in the grand theme of things, the market started to buy this version during the years, during the mid 2010 years. So confidence did come back into the markets. People weren't so disturbed or about the fact that these measures are happening. And at the end of the last decade, the Fed did finally start to kind of normalize their interest rate, or the monetary policy, by increasing interest rates a little bit, by very, very slowly trying to tighten, do quantitative tightening, so reduce the balance sheet. And so I think a lot of people who more or less listen to the mainstream, basically, well, their view was confirmed. Everything is going to be great. And this was a one-time effect. And now I think by now it really should be clear to not, I mean, everybody, still not, I think it's still not the case that everybody thinks that way, but to a lot of, to a very a much bigger percentage of people who follow the markets, that this was not a one-time thing, and that this is the measure which we have to expect is the route which we are going. So I think this conclusion, no normalization is possible, and rather much more loose monetary policy will follow and will be the norm.
The in the In Gold We Trust report, it's written that the everything bubble is now in acute danger of bursting. How is it that despite the virus delivering a damaging blow to the global economy, that the everything bubble has yet to burst? I mean, surely there are knock-on effects that would have pricked it by now.
That is a very good question. I mean, this is also something which analysts are talking a lot about, this huge discrepancy between financial markets and the real economy. I mean, this is the first time that we have an asset price bubble, and I will talk a little bit about that in a second, during a major recession. And so if we look at, for instance, the Buffett indicator, where you look at the total market cap of, in that case, the US equity market and the GDP, this measure was at record highs before the first quarter of 2020, before this whole thing had this huge, produced these huge volatilities at the markets. And is back up on records again. So that I think is really and truly a tremendous fact, and to me points into the direction that this everything bubble was, at least for the time being, able to be, I mean, reflated. It didn't really deflate. I mean, only very shortly. We had a big drawdown in equity markets and risk off move, gigantic risk off move. But these sheer amounts of monetary and also fiscal stimulus, which were taken as a consequence, this obviously had the consequence of pretty fast reflating this bubble back to all-time highs again. So yeah, I would agree that that's a little bit of a surprise. But then again, I mean, equity is one story, but you have other markets, even the bond markets, the spreads which exploded during this crisis came back down very fast, probably mainly because central banks around the world have started or are increasing their bond buying programs and expanding these into the corporate sector, which the Fed now also is doing. So financial markets love that. And for the time being, there are no questions asked what the consequences will be. I think we have, or let's put it that way, I think financial markets have one thing going for themselves right now still. And perhaps this is also the most important dynamic, which I think one should watch very carefully. So the velocity of money has been going down structurally for more than 2 decades actually now, and the velocity now even dropped extremely fast. So we have this deflationary dynamic which is preventing this huge tsunami of liquidity going outside of the financial markets. And again, similar to 2008, perhaps even one could say better than 2008, the central banks were able to prevent this deflationary spiral, downward spiral, which is inherent in our debt-based monetary system. But the question will be what happens if this dynamic changes. And so I am very critical that, again, that they can reverse all these measures and that they can normalize it. And that's precisely due to the fact that we have become so addicted to debt. So we will have a very difficult time raising the interest rates, sucking out this liquidity out of the markets via balance sheet reductions. But so long, and for now, this is still a fact. As long as this velocity still is moving lower, I think what I would like to point out, perhaps shortly, is the sheer amount of money is not only staggering and mind blowing. It's actually not comprehensible for our minds because. I think not many people can actually imagine a number of a million. A million to grasp a million is quite difficult, but still it may be possible in terms of a big city. You know, okay, so many millions live in a big city. When it comes to billion, that's really difficult. That's 1,000 million, obviously. Now we're talking about trillion. We're talking about trillion dollars, euros, and so on. So just in the time frame of 3 months, the Fed has increased the balance sheet at the rate of 3 trillion US dollar. And I have two, I think, quite nice analogies to try to make this number a little bit more comprehensible. So have you perhaps you know that, but what do you think how long would it take if you want to count to 1 trillion? If you count $1 each second, have you any idea how long you would have to count day and night till you reach 1 trillion?
I did see one where if you measured it in seconds, a trillion seconds would take you back to around 30,000 BC or something like that.
Exactly. It's exactly that number, 32,000 years or so. You need to count 32,000 years to go to. So this is not comprehensible. And then they printed three of these 32,000 year blocks. And then just a second one, if I may. If you would have been born in the year 0 and you would earn $1 million every single day, you wouldn't be a trillionaire yet today.
Wow. From the year 0.
At the year 0, every single day, 1 million money is less than a million days. So this is crazy. So if you think about these amounts of money are flooding into the financial markets, to me it's very obvious that this is a high percentage of what the initial question was of this recovery is basically liquidity driven. That's to me very obvious.
How about Europe? What's the economic situation in Europe, and is the Eurozone, is it on the cusp of another banking crisis?
Well, it always has been kind of on the cusp of a banking crisis since the last almost 10 years now. That's one of the known unknowns, as one could put it. For now, it seems as if confidence still is here. Yeah, but I mean, the banking sector is very integrated, obviously, into the whole political structure of the Eurozone. So I think a big banking crisis will probably arise immediately once the whole structure of the Eurozone is questioned. Once, for instance, also another known unknown in this equation is Italy, for instance. The debt levels of Italy are highly unsustainable, but also Spain isn't looking very great and so on. And these are not like Greece, but these are huge members of the European monetary zone in terms of their economic weight. So if we'll see obviously a breakup of the Eurozone, then you definitely will see a banking crisis coming with it. And then it gets very political then. So it's at the end of the day probably a political question of how long can one perpetuate basically this current situation, which is a monetary union which is not completed. It's just like a union on terms of monetary economics and not fiscally. It's no fiscal union yet, and there's the drive to kind of complete this union into a fiscal union as well. And again, this crisis is kind of used to push into this direction. But I'm very doubtful that the fiscal union will be able to complete it, since a lot of people are very skeptical in providing permanent wealth transfer from the north to the south, and I doubt that this will be able to be completed. That's my personal view.
Okay. It seems that the answer of central banks these days to economic problems is to just print more money. And, they may tout to the media that they have all these tools at their disposal, all these tools in their toolbox. But at the end of the day, the only tool they have is money printing or some sort of derivative of money printing. Are central banks trapped in this money printing cycle where they have to expand credit to prevent the implosion of the system?
Yes, I think trapped is the right term. Actually, my dear partner Ronnie and two other friends of ours just recently published a book on that topic, which is called the Zero Interest Rate Trap, which is basically talking about exactly this problem. Because again, one can go back to the European example, but it is valid in different regions of the world. In Europe, during the Euro crisis, 2010, 11, and 12, the big argumentation was we need to lower the interest rates, give these indebted countries some time, some leeway to breathe, so that they can basically restructure and get more conservative and get their act together, fiscal act together. But the problem is zero interest rates do not incentivize this kind of behavior. So by kind of buying them time, and that was often used, this phrase, that was actually giving them the incentive to digging them into a deeper hole. And this is, I think, in essence, this trap. You lower interest rate. Unfortunately, on a short-term basis, this measure seems to work. We seem to feel a little bit better if we go into more debt, and if the central bank provides more liquidity. It's just like this drug addict which gets his shot. And so the Keynesians think, yeah, actually our measures are right. We're doing good, and you see the economy is recovering. But it's really only economic activity, as I like to term it. It's not real legitimate growth which you produce by that. People may move around a little bit more of goods and so on. But the whole economy is skewed during this process and is getting more and more unsustainable. So so in the short run you get some kind of a push, but in the long run you actually mess up the situation much more, and people get more and more into debt, and it gets more and more difficult to get out of the situation. So to answer your question, I think there's only the route forward: print more money and go even more to the negative side, perhaps, of interest rates. But they can't really do anything else. I think. Yeah, you're right.
Yeah, because it seems like, especially in a zero to low interest rate environment, you got deflation on one side, and they're trying to get inflation on the other side. But it seems like we're just going to be stuck in the middle with stagflation, dead center between these two. Anyways, surely the central bankers, they know that they're in this trap. And I would like to think that they are not blind to see the debt piling up. But the economic activity, as you said, continues to be, or it's been anemic for years. Have you heard of any credible solutions from central bankers, whether announced or rumored, that they will get them out of this money printing addiction?
Oh, personally, I don't have, but my personal view is that you have some central bankers who really know that we are in a very big problem. But I think you've got perhaps even the larger part of central bankers who actually believe in what they are doing. I mean, for instance, 2008 again, or the measures which were taken in the aftermath of 2008 are generally perceived as a success story. And I mean, it started in the US and Europe, for instance, the ECB was quite critically. They didn't do as much QE initially, but then as the US seemed to recover faster and more rapidly, I think the notion spreaded. Well, this is actually a good thing. We can save the economy by doing this, and I think this view, a lot of people, a lot of central bankers generally hold this view. Again, I do think there are a few of them who kind of know real economics and know that they're managing basically a wealth transfer system. That's what it is to me, at least, by printing more and more money and giving it only out to some specific groups of people. This is a permanent wealth transfer which is going on. That's, by the way, one of the questions the ECB, for instance, will not answer. I mean, you can. I'm quite active on Twitter, and you sometimes they give you the opportunity to ask the ECB, and I regularly ask them a few questions. And they, sometimes, to their credit, I have to say thanks. They do respond, which I think is a good thing. But I've regularly asked them the question of counter-yo effect. If they know about it, and it is actually a fact that this monetary inflation is a transfer of wealth, and this is something I have never heard one central banker talk about. So yeah, this is I think a very tricky question, but so I went off a tangent here. But yeah, some of the central bankers know about the monetary system, know that they are basically managing this transfer of wealth to the state and perhaps to wealthy people. And what could be the solution? Again, there is this one wouldn't say theory, but this one viewpoint out there that this revaluation of a gold price could help them out. I mean, that would be basically kind of a real devaluation of the debt levels if you start measuring debts against gold. And at the end of the day, I think it's not a coincidence that central banks are buying gold, or at least holding their gold and not selling gold. And you had quite a few central banks putting out some quotes pointing to the direction that they are aware of the fact that there could be some kind of a reset, or even if it's only a revaluation or something like that, that gold will be the measuring point, you know. So I think that's basically the only thing that I can come up with what could bring us out of this what seems to be a situation which is not handled, which one cannot handle in terms of debt. So reevaluate the gold price. And at the end of the day, I think if it's not done kind of by open market operations via a central bank, the market will take care of it. So the revaluation of the gold price will come, because you cannot, in my view, have such a huge debt pyramiding on such a small kind of value of gold.
Yeah. When that revaluation does come, where do you think gold will be revalued at? About what ballpark guess? Your best guess?
Well, we have. I mean, you surely know all these ratios. If we take the gold reserves of central banks on the one hand, and value them with the market price currently, and you take all broad money supply, or even only central bank money supply, you can actually produce these kind of ratios. The shadow gold price is something which people sometimes look at, which implies that you have are going back to 100% backed gold standard, which I personally doubt. But perhaps I can refer to our report here. What we are looking and what we are also giving kind of as a benchmark perhaps for this decade where the gold price actually could go. We are looking at US dollars, and so that's why we're looking also at the US monetary aggregates. What we looked at was a broader monetary aggregate, in our case M2. It's not as volatile as the central bank balance sheet, for instance. And we looked at the historic inflation of M2 and during the past decades. And depending obviously on this rate of inflation of M2 and also implied coverage rate of the gold price, we estimated a price of 4,800 in a very conservative scenario at the end of the decade. If we see a more inflationary scenario, which I think is quite probable, then we would probably estimate something close to $10,000. So I think these are some yardsticks which one can look at and which we will monitor and also talk about in the years to come. So we will definitely look at these kind of our models and keep people up to date how we are doing in terms of implied gold backing of all these fiat currencies.
I just want to touch on the market. Well, a couple more things. What do you make of the record highs in the stock markets on the backdrops of record unemployment in the U.S.?
Yeah, crazy things going on. I mean, you have a few components, I think, in that regard, which are interesting. Well, we talked about this liquidity tsunami, which is probably the trigger for all of that. But you have, like, for instance, this phenomena that a lot of retail participation has been starting recently. This famous Robinhood app, which is really targeting the super retail level, where people who perhaps even ironically got some kind of a government help started to trade tiny amounts of money with these kind of brokerage companies and put retail money into the market again. I think that's one part of the component. The other part is the concentration of index components. So if you, for instance, look at the Nasdaq or also the S&P 500 and these kind of indices, these rising index levels are not don't have a huge breadth behind them. That's also something I think which should be quite concerning. We also saw that at times at the end of equity bull markets that these rises in index levers are driven only by very few names. That's definitely going on. And the third component, which I think is mentionable here, is also the passive investments. People are flooding into ETFs, which again helps these big names, obviously, because the ETF blindly invests into all of the companies at the levels of the index. So yeah, we just see just additional flow into the markets, pushing some names higher, and I also don't think that that's very sustainable personally.
I'm going to pronounce this gentleman's name incorrectly, so I'm going to apologize ahead of time. Chamath Palihapitiya, CEO of Social Capital. Sorry, sir. I'll have to repronounce his name again. CEO of Social Capital said in a recent interview that the gold standard was abandoned during the Great Depression as it was the only way to buck the deflationary trend of continuous falling prices. Do you agree with his assessment, and are there limitations to the role of gold in a monetary system that perhaps money printing can address better?
Yeah, I mean, I can't pronounce his name better than you, so I won't even try it. But I know the guy from the interviews he gave recently, and also back. I've been following a little bit the guy. Very interesting character, I think. Brings up some very good points. Look, in my view, I mean, the first thing I would disagree a little bit, even though that's a detail, but I think it's mentionable anyway. The gold standard, I think, really was abandoned in 1913 already, the classical gold standard. What was left of it was the 20th century, basically, is the history of diluting what was the rest of the gold standard more and more until we reached 1971, when we got rid of the last bit. What remained there. But that's true. Obviously, in 1933, something very important happened again in this journey to pure fiat money. The way I see it is, I think the core of the problem is the debt-based character of our currency. And once you have the currency, which has basically which is basically more debt-based than not. Basically, it creates this need for inflation. So he's not quite wrong. So you already in 1933 had a partly debt-backed currency, and especially if you take into the consideration the broad money supply, which was increased hugely during the 20s. That's often forgotten in all these discussions about the Great Depressions in the 30s. What was actually the root cause of the problem? Then one has to look into the 20s, or actually even go back further to 1913 again, when the Federal Reserve was created, because due to fractional reserve banking, the broad money supply, which is also basically debt, they call it credit, but whatever, it's created as the money is created as debt, as liability, and it has an interest on it. So the broad money supply was increasing in an unsustainable way. And so the natural tendency was that this broad money supply, at one point when the business cycle ends, will contract again to lower rates, and this process obviously is not very pleasant. And interventionist policy thinking is, well, one has to stop this and stop the pain which is going on. And with this worldview, the guy's right. I mean, I would agree. Yes, one couldn't reflate this bubble. And then that's the whole Keynesian thinking. I think this is the core of the whole Keynesian thinking. One needs to reflate the bubble. One don't want to go through the pain. And in taking this view, I would agree. But the root cause, as I said, is not to, or the solution. Let's put it that way. The solution to this arising problem, which is a regular deflationary crash, which always inevitably at one point comes when you inflate too much. The root cause is not to go off any hard money standard and then print up even more. It's the easier solution, and it's the solution to try to drag out basically the final reckoning. But it's definitely not the sustainable solution. The sustainable solution would to install a monetary system which prevents these kind of credit inflations, and prevents also these busts which come as a consequences. And then you don't even have the need to ask the question: do we have to reflate or don't we have? We shouldn't even be able to create such huge artificial booms. I think this is how one should look at it.
Okay, it's a good point. I guess you and I have some homework where we gotta figure out how to pronounce his last name there. But 2020 in Gold We Trust report, there was a chapter titled "Gold and Silver: A Biblical Perspective," which was absolutely a good read. And then there was also a chapter on gold-backed tokens in 2020. My question here for you: are gold-backed tokens, which had a full chapter dedicated to them in the report, The future of monetary systems that blend the solidity of gold and the technological advancements.
I would not dare to say they are the future of a monetary system. I would perhaps agree that they have the potential to form a great basis for a monetary system. And obviously, we find this topic very fascinating. Otherwise, we wouldn't cover it in our report. Yeah, this blockchain technology, or more generally, perhaps the internet, the telecommunication, whatever you want to call it, this opens up a lot of possibilities to transact gold and account have better accounting. Who is the real owner and so on, which also, for instance, helps to solve the question of small amounts, for instance. How can you transact small amounts? Physically, it's quite expensive. Doesn't make sense to invest in very small amounts of bullion, as you know. So that suddenly these possibilities open up. So that's obviously a positive, big positive. We view this whole technology also positively from the point of view that we are happy if people have easier access to gold, and I think this is definitely something which does help the access to gold, but, and that's an important but, currently still today, I think we haven't seen a huge breakthrough in any of the existing gold tokens, if you want to call them like that. And that's also, I think, it is also quite important to think about it conceptually, because owning physical gold is obviously, as we all know, the only way to own a financial asset without counterparty risk. And putting gold on a blockchain, for instance, is adding some kind of counterparty layer to some extent. So I mean, perhaps there will be some solution to that, but I have a difficult way to imagine that one can eliminate all kind of counterparty risks. One can reduce it probably, but still one adds this kind of layer to it. That doesn't have to mean necessarily that it's not helpful, because I personally don't see counterparty risk as something extremely bad. One just has to know who is your counterparty and needs to be informed correctly and so on. But one has to be aware of the fact that one is involved with a counterparty. It's the same thing with storage, right? I mean, you have a counterparty suddenly, and I don't view that as a bad thing, because they're good providers who do a great job, and it's a service, and people like to take advantage of it. So in the same view, in the same perspective, one can also view blockchain solutions. But one just has to be aware conceptually one does add some kind of a counterparty in there. So I think it will not kind of replace the physical gold market completely, but it could be complementary. And in that sense, I like the development, and we like monitoring the solutions which are coming up. But still, they are pretty small, and there's not such a thing yet which had already a huge breakthrough in my view.
Okay, last question. With the or will the advent of cryptocurrencies and gold-backed tokens, will it diminish the role of silver, since technology has provided solutions to transact in fractional amounts of gold?
I think, Patrick, this is a very good question. I like silver, and I'm very constructive regarding the price of silver. Silver is this interesting animal which is half monetary metal and half industrial metal, and it can morph a little bit more into the one or into the other. So that gives it some very, very interesting risk-return characteristics. Having said that, from the monetary side, silver obviously was historically used for the smaller amounts, the smaller transactions when it was used as money, pure silver standard or bimetal standard, something like that. Silver mostly played a role during the times when we had precious metals as money. Exactly to the problem which we've been talking about, due to the high value density of gold, it just is interesting to have a second layer kind of. So I don't think, let's put it that way, I don't think that silver will have a huge an official monetary role anymore because of these developments. If we want to go back to sound money via gold or whatever, then we have the technologies to have a small denomination in gold, and I have a difficult time to see that we have some kind of a bimetallism coming back again. Having said that, as a store of value, I think still it has huge potential, because first what we first have to all go through is the big revelation that this monetary system is not sustainable. Most of the people are not aware of the fact, and I think what will boost this kind of enlightenment will, at the end of the day, at some point, be some kind of a big inflationary move. And during that inflationary move, I think this reflects, which silver has built in it, still has, that during a rising rate of inflation, a lot of people will rush into the silver markets. And given that it's so small, I think silver has a huge upside potential as a store of value. But not so much. I don't see. I agree. If that was your premise, I agree with the statement that silver probably will not have a huge role in any future monetary system.
Okay. Mark Valek, before we wrap up, can you let our listeners know more about the In Gold We Trust report and the cryptocurrency report, which you are also the co-author of?
Right. So you can find all the infos on the In Gold We Trust report on our webpage, which is ingoldwetrust.report. That's one word, ingoldwetrust.report. You can download it for free in English, in German, and in autumn we will again release our Chinese version in Mandarin. Also, what I think is notable, if people are also interested in Bitcoin to some extent, I write a monthly commentary, which is available at noninflatable.com. I write about these kind of market thoughts which I have, and you can also go there if you're interested and curious.
Okay, noninflatable.com, is that a new one for you?
Yes, that's a new one. It's actually part of our new fund product where we combine physical gold and Bitcoin, and we do an active rebalancing strategy and option writing. We just started this fund a few months ago. It's doing very well, actually. And so for people who are interested in this kind of things, happy to see them on our homepage there.
Okay, Mark Valek, we appreciate the time you've given us and hope we can do this again soon.
Thanks so much, Patrick. All the best.
Thank you also. All the best, Mark. That was Mark Valek from Incrementum AG and the co-author of the In Gold We Trust report. For more info on his insights on precious metals and the global economy, please visit his website, incrementum.li. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.